1875 that we actually came and had complete confirmation that money is gold and all the rest is credit.
Well, every time we speak, it doesn't make me feel any better. I guess I feel more informed, but more informed about how big and how massive, how looming, how much growing, impending this imbalance, the systemic troubles are in the global and regional and sovereign banking systems, and how any major tipping of any of those over could pull the whole thing down. In the face of that, you've reminded us what people can do. You know, here we ordinary mortals trying to shuffle along here and take care of our families, take care of our children, our grandchildren, and our futures, to protect ourselves, to take a more defensive posture against this runaway expansion of risk by the central banks globally.
Yeah, I mean, it's the only thing to do is to try and get out of the fiat currency system. How do you do that? Well, the only way you can do that is to get into proper money. Gold is legally money and has been since Roman times. It was codified by Justinian back in 6th century, I think. So that was an awful long time ago. And it's, from Roman law, it has been adopted in everyone else's law, basically, indirectly usually. I mean, in this country, it was very indirect because by the time Justinian codified money, credit, currency, and its legal status, we'd already, the Romans had already left Britain. So, but it came up sort of thing through common law. But it was only really when the Court of Chancery was merged with common law in 1875 that we actually came and had complete confirmation that money is gold and all the rest is credit. And that is actually precisely what J.P. Morgan said in 1912 ahead of Congress. I mean, he wasn't expressing an opinion, he was expressing a legal fact, and that point is missed by most people. Excuse me. Quite a lot of your listeners, viewers, will, I think, sort of look at the price of gold and they see it sort of sinking and all the rest of it and think, oh, don't make the mistake of looking at it as an investment. It's not an investment. Money is not an investment. Money is something that you hoard. You don't invest in it. The distinction is terribly important. And the reason that this really matters is that the markets and the gold price through futures is driven by the investment community. And the investment community are essentially Keynesian. They've all gone to university and learned Keynesian economics from high school level through, university, college, whatever. And for them, the safety is not gold, it's the dollar, which is why we're seeing the dollar rise. And if you look at what happened after the Lehman crisis, gold actually went down because these guys who are completely clueless about economics, as I said earlier on, they sort of think, well, gold is a pet rock, or, I prefer cryptocurrencies, or whatever their story is. The result is that there are no buyers for gold when this problem happens, no buyers for synthetic gold, paper gold. But I can tell you that the central banks themselves are quietly squirreling away gold on the dips, making it quite difficult for the bullion banks to actually get their books completely straight. And that's an interesting point. If the central banks are squirreling away physical gold, shouldn't you as well? I mean, because it's money. It is money.
That's funny because that the terminology of bad talking something while acquiring it is called bash and stash, and it seems like that's what's been going on at a very high level for some period of time.
Yeah, pretty much. I think it's a very good way of putting it. Yeah, I would agree.
Your description of the Target 2 system in Europe for gathering up sort of all these debts that are being owed by the European sovereign banks, that sort of thing, central banks, into this system is a little bit opaque to people in the U.S. because we just haven't been following it very closely. But the one thing that impressed me about that when you've described that to us several times is that we've been warned by several analysts since the global financial collapse of 2007, 2008, that the next time we get this far, it won't just be Lehman Brothers or Bear Stearns or whoever that needs bailing out. It will be sovereign governments. It will be central banks that need bailing out. And when you describe that, it makes it sound like the mess has been pushed under the rug and pushed upstream, up the food chain to now where it can be hidden in this almost completely inscrutable place to most people. Who's in charge of that, and who are they answerable to, and how do you vote them out or get them to fess up or tell you the true accounting of their, to do an audit, that kind of thing. So in other words, we've been told by others, as perhaps unstable as the credit system might be, we're not in as bad a shape as we were back in 2008. Whether it's in the real estate market, we don't have these crazy loans being given to people who don't have credit worthiness. We don't have lending going out to the extent that it was back in there, and the bank ratios aren't as bad in the U.S. So we're not on as slippery a footing as we were back in right before the global financial collapse. But that may be, is it not, just because all these problems have been pushed upstream to where now in fact the problem might be an order of magnitude larger, but it's just up at another different place in the food chain, higher up, that it could be more systemically impactful should it fail.
Yeah, no, that's right. As to your comment as is an elected official responsible for this, the answer is no. There's no democracy in Brussels, I can assure you. There's a sort of democracy in name only, but it's all controlled basically by the executive, who are unelected. I mean, they don't have to stand for votes, to get voted in or anything like that. And Christine Lagarde, who's the chairman of the ECB, was appointed as a safe pair of hands. Before that, she was chairman of the IMF, and before that, she was a finance minister in the French government. Some people like to point out that she was indicted on fraud, but she's a lawyer. We'll pass over that one. She was seen as a safe pair of hands, but the reality is that she's been given an impossible task. One task is to continue to do what the ECB has been doing, and that is to redistribute wealth from the northern countries to the southern ones, so that Germany, Holland, Netherlands, the Luxembourg, I suppose, and also Finland, within the Eurozone, they're effectively having their wealth removed from them through a system of depressed interest rates to below the zero bound to, sort of Spain, Italy, Greece, Portugal, and so on and so forth. So one of the things she had to do is to continue to do that. But that game is now coming to an end because rising interest rates brings that game to an end. It's as simple as that. And the other thing, I mean, she's presiding over a system which is so fractured. It's only a matter of time, and very, very little time, I believe, before the whole thing falls over. So she's got an impossible task. And I think to blame any one individual for this is really rather difficult. It's a systemic problem, as is so often the case. I mean, when you look at the Fed, for example, they've got, I don't know how many economists working on high salaries there, but they don't know anything about economics. And if I was to go in there and tell them a little bit of sort of Austrian economic reality, I mean, I would just draw blanks. I mean, I may as well talk to Paul Krugman. Forget it. We're on different planets. This is the problem. And so you have got this sort of systemic groupthink, which is completely rudderless in terms of where it's going. And now what they're doing more and more than ever before is they're just responding to the crises as they occur. And as you say, brush it under the carpet. There's something, there's a bit of dust over there. Quick, push it under the carpet. Yeah, so it's very much that's the way it works, I'm afraid. It's the same with every central bank, really. They haven't got a clue what they're doing. The other aspect of brushing things under the under the carpet is, if you like, from an Austrian economic point of view, talking about the credit cycle, something which I call the bank credit cycle. They were not so definite on it. But unless you allow the excesses of one cycle to wash out when the cycle contracts, that sort of creative destruction which Schumpeter was talking about, though he wasn't actually quite talking about it in that context, but it does as a metaphor. Unless you allow that to happen, then you just store up trouble for later. And what central banks have been doing, I mean, particularly since Volcker raised interest rates to just kill the inflation bug stone dead back in 81, what they've been doing ever since is just brushing it under the carpet. Every time the bank cycle, which is roughly 10 years in duration, every time it turns down, they catch it. They expand the quantity of central bank money. They support the banking system. They push money into it. They push down interest rates. And by doing this, what happens is that the businesses that should have gone bust because they're, incapable of earning something to pay their debts, they're in effect tying up capital in the economy, which could otherwise be far better deployed elsewhere. That never washes out. And so we've had this time and time and time again. We very nearly came completely unstuck on the Lehman crisis, but they rescued it again. And now here we are, not 10 years later, 13 years later. This cycle has played out. It's been distorted, I think. You could argue it's been distorted to some extent by COVID, but we're now 13 years. This is very long in the tooth. So when this crash comes, I think it's going to be like a tsunami because of all the stored up brushing under the carpet, as you put it, that's been occurring ever since 1981.